Good day, guys. Good day. Hope you're good. We're continuing with the candlestick trading Bible decoding. Okay, so we're on page 20. All right. The Doji candlestick pattern. Doji is one of the most important Japanese candlestick patterns. When this candle forms, it tells us that the market opens and closes at the same price, which means that there is equality and indecision between buyers and sellers. There's no one in control of the market. See the examples below. Okay, so this is what a doji candlestick looks like. As you see, the opening price is the same as the closing price. This signal means that the market didn't decide which direction to take. When this pattern occurs in an uptrend or downtrend, it indicates that the market is likely to reverse. Okay, so I'll highlight that. Okay, when this pattern occurs in an uptrend or a downtrend, it indicates that the market is likely to reverse. Okay, here's an example. You can see price was pushing up. Right, then we had the doji right there. Then immediately after, the price reversed. Okay, that's a sell example right there. The chart above shows how the market changed direction after the formation of the doji. The market was trending up. That means that buyers were in control of the market. The formation of the doji candlestick indicates that the buyers are unable to keep price higher and sellers push prices back to the opening price. This is a clear indication that a trend reversal is likely to happen. Remember always that a doji indicates equality and indecision in the market. You will often find it during periods of resting after big moves, higher or lower. Okay, so you should just anticipate to get a doji on either side. So if price is pushing down, you can just anticipate to see it, then anticipate to buy. If the price is pushing up and you see it, you anticipate the price to drop. So when it's found at the bottom or at the top of the trend, it is considered as a sign that a prior trend is losing its strength. Okay. So if you're already riding that trend, it's time to take profits. It can also be used as an entry signal if combined with other technical analysis. So if you're already in the trade, you just close your trade. You know the price will most likely reverse. So there's another type called the Dragonfly Doji pattern. The Dragonfly Doji is a bullish candlestick pattern which is formed when the open high and close are the same or about the same price. What characterizes the Dragonfly Doji? I'm struggling to pronounce this word. What characterizes the Dragonfly Doji is the long lower tail that shows the resistance of buyers and their attempt to push the market up. See the example below. Okay, so this is a bullish candlestick, the Dragonfly Doji, right? You can see the tail, open price, close price is the same. The illustration above shows us a perfect Dragonfly Doji. The long lower tail suggests that the forces of supply and demand are nearing a balance and that the direction of the trend may be nearing a major turning point. See the example below that indicates a bullish reversal signal created by a dragonfly. Okay, so you check it out, there it is. So one thing I want you to notice is, after this dragonfly doji, price didn't just immediately go up. There was a bit of consolidation there, or an area whereby price was just playing in the same zone, right? Before it finally decided to push up. As you can see here, they were playing right in the same zone. So sometimes when you see these signaling candles, do not execute the trade immediately, right? Just watch to see how price is acting, or maybe wait for a zone to be broken or something. But most of these things will be explained in the next pages. So in the chart above, the market was testing the previous support level that caused a strong rejection from this area. The formation of the Dragonfly Doji with the long lower tail shows us that there is a higher buying pressure in the area. If you can identify this candlestick pattern on your chart, it will help you visualize, see where support and demand are located. When it occurs in a downtrend, it is interpreted as a bullish reversal signal. Okay, but as I always say, you can't trade candlestick pattern alone. You need other indicators and tools to determine the higher probability Dragonfly Doji signals in the market. All right, Gravestone Doji. Okay, so before we proceed, let's just slide to the charts and see if we can get the Doji first. This one, we want to look for the Doji. And we want to look for the bullish, this bullish Dragonfly Doji. Okay. Quickly go to the charts. Okay, this is a current running trade. I won't get much into it. I'll just be popping in and out to see how price is playing out. Okay, so we're going to go to V100 for our illustrations. Okay, so we're looking for a Doji first. Okay, we've got one here. We've got one there. But remember, it has to line up with certain confluences for it to mean something. So this one here doesn't mean anything. This one here doesn't mean anything. This one here doesn't mean anything, right? Because they are just caught up in ranges, in between ranges, where the price is not actually really doing anything. Okay, let's see. We're also looking for a Dragonfly. Okay, there's a Doji on the bottom there. So I want you to see how we had a couple of Dojis. Okay, resume share. Okay, I want you to see how there's a couple of Dojis there. Okay, this one you understand it was a rejection to a moving average. Okay, maybe, okay, let me not confuse you with moving averages for now. Okay, right here is a perfect Doji right there. So overall, the price was pushing down, right? Then eventually we get a Doji, which is shielded by one black candle, one green candle. That's a buy signal. It's a clean reversal. It's like a V. Okay, then you get your Doji there. So price was coming down. That signals that your price is going up. So that one is a perfect one for buys. Okay, this looks like a variation of a Dragonfly Doji. But as you can see, price did not push up. As much as we were coming down, there was no follow through. Right? There wasn't any follow through to signal a reversal. So if certain things don't line up, these candles don't mean anything. Okay, let's see on the bottom. Here's another one. Didn't line up with anything. You see price continue to push down. This can be considered a Doji there, which was followed by a bullish engulfing. Right, so you can consider taking that one, even though the up move wasn't big, but there was something. And also consider that this is a daily chart. Okay. We've got one here, doesn't mean anything. We've got one there. Price sort of stopped, did a stop hunt, then it eventually dropped. Followed through with a bearish engulfing, as you see there. Then they dropped. So basically, these are the things you need to be looking for when you come to the charts. If you see a signal candle, check if there's anything aligning with that, be it an indicator on the bottom there, be it support and resistance zones. If there's nothing lining up, then it doesn't mean anything. But if something lines up, then you take the trade. Okay, so I don't think there's many Dragonfly, bullish Dragonfly dojis. Okay, there's one there. Okay, so initially we had a doji. You see we were coming down. Then we had a Dragonfly doji right there. And you can see it's rejecting off a moving average. So that sort of gives it a high probability. Okay, so follow through candle, then the price just pushed up. It was actually an uptrend. Another doji there, but this one didn't mean anything. Price didn't reverse. Price was just in an uptrend. It continued pushing up. Okay, so let's go back to the book. Okay, so that's the Dragonfly. The Gravestone Doji. I think this should be the opposite. Let's just confirm. The Gravestone Doji is the bearish version of the Dragonfly. Okay. It is formed when the open and close are the same or about the same price. What differentiates the Gravestone Doji from the Dragonfly Doji is the long upper tail. The formation of the long upper tail is an indication that the market is testing a powerful supply or resistance area. See the example below. All right, the candle looks like this. Right, so to get the best of it, price has to be pushing up, right? Then you get it happening either on a moving average or happening on a resistance zone. Once you see it, you know there's a high probability your price will drop. Okay. The image above illustrates a perfect Gravestone Doji. This pattern indicates that while buyers were able to push the prices above the open, later in the day, sellers overwhelmed the market, pushing the price back down. This is interpreted as a sign that bulls are losing their momentum and the market is ready for a reversal. Okay, see another illustration below. Okay, so like I said, it has to happen on a like resistance zone or on a moving average. If you see price started slowing down here, but these three didn't mean anything. Right, price continued to push up probably into a zone or onto a moving average. Then it made sense now. Right, then there was a bearish engulfing there, then price reversed. Okay, so we're pushing up, the doji appeared, price reversed. The chart above shows a Gravestone Doji at the top of an uptrend after a long period of strong bullish activity. The formation of this candlestick pattern indicates that buyers are no longer in control of the market. For this pattern to be reliable, it must occur near a resistance level. Okay. And as a trader, you will need additional information about the placement and context of the Gravestone Doji to interpret the signal effectively. This is what I'll teach you in the next chapters. Okay, so let's quickly go back to the charts again. We want to just quickly search for a Gravestone Doji. Okay, I think I saw quite a few when we were moving the other side. Okay, there's one there. So this is more or less like the example in the book, right? Price pushed up, consolidated, extended, then gave the candle, then dropped. But now on this particular variation of price movements, there was no follow through to the bottom side. Price literally hit the brakes and they continued pushing up. There was also one here, but this didn't mean anything. That means that there was just too much buying pressure. And you can see this moving average was the one holding the price. It wasn't broken. Let's see if we can locate another one. Okay, there's one right at the top there. There we go. So for this one, price drops, even follows through with the bearish engulfing, continues dropping. Right, so that's a perfect example there. Let's see if there might be one more. Okay, this particular one is just a variation. You need to know where your price is going for this to make sense. But I think you will see this particular candlestick in the next couple of pages. It will be explained in detail, whereby you don't find it on the top here. You find it like inside this trend movement. So, and you can already see this happening here and the same candle happening here. It means two different things, even though it's the same candle. So you should just know these candles are traded depending with like market conditions or what's available in terms of confluences lining up. If there is no resistance, if there is no support, then these candles usually don't mean anything. Okay, we've got the morning star. Usually the price will be coming down, then you see a candle like that one, then a bullish candle on the right hand side of it, then you know it's a morning star, then price will actually push up. The morning star pattern is considered as a bullish reversal pattern. It often occurs at the bottom of a downtrend and it consists of 3 candlesticks. Okay, the first candle is bearish, which indicates that sellers are still in charge of the market. Second candle is a small one, which represents that sellers are in control, but they don't push the market much lower. And this candle can be bullish or bearish. The third candle is a bullish candlestick that gapped up on the open and closed below and closed above the midpoint of the body of the first day. This candlestick holds a significant trend reversal signal. The morning star pattern shows us that buyers to control the market from the sellers. When this pattern occurs at the bottom of the downtrend or near a support level, it is interpreted as a powerful trend reversal sign. Okay, so let's look at the pattern again. All right, let's see the illustration below. You can see the example is on a daily chart. All right, there we go. We were in a strong downtrend. Price was pushing down. Then all of a sudden we get that candle happening right there. Right, this can even be interpreted as a doji, right? So as long as you know that, okay, this candle is familiar and it's happening on the zone, you might forget the name, but you should know the use. So once you see it, see there was a reversal in price, aggressively pushed to the upside. The chart above helps us identify the morning star pattern and how it is significant when it is formed at the bottom of a downtrend. As you can see, the pattern occurred at an obvious bearish trend. The first candle confirmed the seller's domination. The second one produces indecision in the market. Second candle could be a doji or any other candle. Okay, that's a point to note there. The second candle could be a doji or any other candle. That's why I said you don't really need to like claim the names, but you need to just know the type of candle. And if you see it happening on a zone or on a moving average, then it will be a high probability signal that this price will actually reverse. Okay. But here the doji candle indicated that the sellers are struggling to push the market lower. The third bullish candle indicates that buyers took control from the sellers and the market is likely to reverse. This is how professional traders analyze the market based on the candlestick patterns, and this is how you will analyze financial markets if you can master the anatomy of candlestick patterns and the psychology behind their formations. Okay, the evening star pattern, I think it's an opposite of the doji, so we'll just go through this one before we go to the charts to look for them. Okay, so let me just check something quickly. Okay, the evening star pattern is considered as a bearish reversal pattern that usually occurs at the top of an uptrend. The pattern consists of 3 candlesticks. The first candle is bullish. The second candle is a small candlestick. It can be bullish or bearish, or it can be a doji or any other candlestick. Okay, any other familiar candlesticks, you know, as long as it is small. The third candle is a large bearish candle. In general, the evening star is the bearish version of the morning star pattern. Okay, so just to know if it's evening, just a quick like example. If the sun is up, it sets, it means it's evening, right? If the sun is down, it rises. That means this is morning. So you might just confuse these names, like saying, is it a morning star? Is it an evening star? Which is which? How do you differentiate? So just know if you're coming from the top, if price was going up, the sun sets, right, goes down. So that's an evening star. From the bottom side, price coming down, the sun rises by price going up. So that's morning. It's a morning star. Okay, that's just like a quick example of how I personally do it. But you can have your own like preference. Okay, so it will look something like this, right? The small candle in between. The first part of an evening star is a bullish candle. This means that the bulls are still pushing the market higher. Right now, everything is going all right. The formation of the smaller body shows that buyers are still in control, but they are not as powerful as they were. The third bearish candle indicates that the buyer's domination is over and a possible bearish trend reversal is likely to happen. See another chart that illustrates how the evening star could represent a significant trend reversal signal. Okay. We are coming up. We get a doji, no follow through, no zone, no moving average. Price continues going up because this means nothing. Then we get one bullish candle, we get a small candle and a big bearish candle. Our entry is here, right? So this whole three candle pattern has to form. So if you're on a daily chart, this is 3 days with no trade. Okay, you necessarily don't have to trade every day. So you can spend 3 days with no trades, but when the setup occurs, you make sure you execute with precision. Then if you catch this move on a daily candle, this is a lot of pips. So this covers for 3 days of waiting for the setup to form. And from here, price just continue to push down. If you're swing trading, then you hold. So these patterns are more powerful on higher time frames. Of course, they are powerful even in smaller time frames, but you should know that the higher the time frame, the more powerful and high probability the pattern and the trade playing out. Okay, so let's see. As you can see, the market was trending up. The first candle is the pattern, indicates the long move up. The second one is a short candle indicating price consolidation and indecision. In other words, the trend that created the first long bullish candlestick is losing momentum. The final candlestick gapping lower than the previous candlestick, indicating a confirmation of the reversal and the beginning of a new trend. Okay. Let's see if we need to slide to the charts, the hammer, pin bar. Okay, let's slide to the charts a bit. So we are looking for, before we slide, right? We are looking for the evening star pattern and the morning star pattern, right? Okay. Okay, so let's see. We look for these candles on the highs and on the lows. I could have considered this a morning star here when price was coming down. Because if you see, I think it's on a zone, I would have considered taking that trade. But there was not much of a follow through here. You can see this downtrend was getting a bit stronger and they failed to break here. So, but I would have taken that as a morning star. So you should know some trades will play out, some trades will hit stop losses, some trades will close at break even. Okay, there we go. Here's a morning star pattern here. We're coming down. The candlestick on the left is a big red one, small one in the middle, big one on the right. Morning star pattern, V shape. Then the price just pushed up. You can see this was like a big swing trade. On the daily chart, if you enter here, you literally held this trade for like 3/4 of the month to catch these highs. So that was a good swing trade. So you see, sometimes you wait for certain setups to play out. They might take time, but when they play out, you just execute and it covers for the time you were waiting. Okay, another one here on the bottom right there. Big bearish candle, doji in the middle, big bullish candle, That's a V. You buy, you execute your buy, and the price just pushed up. Okay, that was also a good trade there. This one is not the perfect one. It's just like a variation because the one on the left, you can see this small one is like a little bit higher, right? But it qualifies. It's just a variation of the pattern. So that one is an evening star. Okay, you can consider this a variation as well, whereby you see two. But this one, all these two are kind of valid, right? Then it's one big one, one big bullish, one big bearish. So you can sell there. Then price of pulled back a bit. Next day, it just dropped. So after seeing this, you can still sell again. Then you can take profit on a moving average. We'll get to moving average in a few pages or in a few chapters to come. So let's see if we can find another one. Okay, this is another variation where instead of getting one, you get two Doji candles in there when price was coming down. So that's your buy. Pattern is complete there. Same applies here. That's one for sell. A huge bullish here, huge bearish here. That's an A top. So we got V's, we got A's. Okay, V's and A's. Then we've got W's and M's. We're going to talk about this in a couple of chapters to come. So I think you've got a grasp of what a morning star is or what it looks like when you're on the candles or when you're on the charts. Okay, this is also a variation, this one here. This candle is a bit big for my liking. I would want to see it close above somewhere here so that it gives me like a range to work with. So this one is a bit big, so I guess it's just a variation. Same applies to this one for sales. Which other one? If there is no follow through, you see here there was no bullish candle. It means the pattern is not complete and it's invalid. Okay, so basically that's it. Okay, just one more right there. We're coming up. It's a bit of a variation because there's like a few more candles in there, but same pattern. Okay, there's your entry. So let's slide back to the book. All right, as you can see, the market was trending up. The first candle in the pattern indicates the long move up. The second one is short candle indicating consolidation and indecision. In other words, the trend that created the first long bullish candlestick is losing momentum. The final candlestick gapping lower than the previous candlestick is indicating a confirmation of the reversal and the beginning of the new trend down. The hammer or pin bar. Okay, let me just do this quickly. Okay, I'm back. The hammer candlestick is created when the open high and close are roughly the same price. It is also characterized by a long lower shadow that indicates a bullish rejection from buyers and their intention to push the market higher. Okay, pin bar. Okay. See the illustration below. Okay, it looks like this. This is what a hammer pin bar looks like. Right, so you can call it a hammer, you can call it a pin bar. Hammer or pin bar is basically the same thing. Right, so you can see there's little to no upper shadow, closing price, opening price, long lower shadow. When you see this candle, it indicates buys. Right, if you see it on a moving average, it indicates buys. If you see it on a support zone, it indicates buys. Okay. The hammer is a reversal candlestick pattern when it occurs at the bottom of a downtrend. Okay. This candle forms when sellers push the market lower after the open, but they get rejected by buyers, so the market closes higher than the lowest price. See another example below. So you can see on this particular example, we're pushing down. Then we had the candle right there, long shadow, then it was a reversal, right? So if price is pushing down, then you see it appear on a moving average or on a support zone, it becomes a reversal, okay? As you can see, the market was trending down. The formation of the hammer or pin bar was a significant reversal pattern. The long shadow represents the high buying pressure from this point. Sellers were trying to push the market lower, but in that level, the buying power was more powerful than the selling pressure, which results in a trend reversal. The most important to understand the psychology behind the formation of this pattern. If you understand how and why it was created, you will be able to predict the market direction with high accuracy. We talk about how to trade this pattern and how to filter this signal in the next chapters. Okay, so then we've got the shooting star. This is a bearish pin bar. It's just the opposite of the hammer. Okay, so the opposite of the hammer is called the shooting star. The shooting star formation is formed when the open low and the close are roughly the same price. This candle is characterized by a small body and a long upper shadow. It is the bearish version of the hammer, right? Professional technicians say that the shadow should be twice the length of the real body. See the illustration below. So you can see this is how the candle looks like, and this is a bearish pin bar. Okay. Just okay, the illustration above shows us a perfect shooting star with a real small body and an upper long shadow. When this pattern occurs in an uptrend, it indicates a bearish reversal. I want you to check where on most illustrations, the author is saying the illustration above shows us a perfect, right? A perfect shooting star, a perfect doji, a perfect pin bar. It's because there will be variations. This is the perfect one, but on the normal charts, when you see price, these candlesticks, all of them, they come with certain variations, and I'll just try to pinpoint them out so that you can clearly understand. So the psychology behind the formation of this pattern is that buyers try to push the market higher, but they got rejected by selling pressure. When this candlestick forms near a resistance level, it should be taken as a high probability setup. Okay. There's the example, price was pushing up, we get our shooting star or the bearish pin bar, then price pushes down. The chart above shows a nice shooting star at the end of an uptrend. The formation of this pattern indicates the end of an uptrend move and the beginning of a new downtrend. This candlestick pattern can be used with support and resistance, supply and demand areas, and with technical indicators. The shooting star is very easy to identify and it is very profitable. It is one of the most powerful signals that I use to enter the market. I can actually testify to this. As a guy who read this book and who's actually reading with you now, if we go to the charts or even if you're on the charts by yourself, it's very easy to identify these candles. You just want to look for your shooting star or a bearish pin bar, and you want to look for your bullish pin bar. When you see this candle, just look for confluences which makes it valid. So you look for your moving average, you look for your support and resistance zones. But I'll try to explain these in the next pages to come. Okay, in the next chapters, I'll talk about it in details and I'll show you step by step how to make money trading this price action setup. Okay, the Harami pattern on the inside bar. Okay, so let's go to the charts and look for the bullish and bearish pin bars before we get into the inside bar. So we're going to slide into the charts. Right, we're looking for bullish and bearish pin bars. Okay, this is a variation. You see it's happening on a moving average, and price didn't drop straight. There was a bit of trapping there before the price decided to drop. Okay, this one is a bullish pin bar, and this one is happening as a trend continuation. I think we'll see it in the next chapters where they explain that in greater detail. Okay, let's see, there we go. Bearish pin bar. So remember, the color doesn't matter. It can be green, it can be black. Bullish pin bar. Bullish pin bar. Doji. Bearish pin bar. Bullish pin bar. Okay, what do we have here? Bullish. Right, these can qualify as variations as long as the wick is like 2 times the size of the body. They qualify as bearish engulfing, as bearish pin bar. Sorry. Okay, this one there was no follow through here, so this one didn't play out. So some will play out, some will not. These are all bearish pin bars. This one is invalid. This is a bearish pin bar, but where it happened, there was nothing supporting it, so it didn't mean anything. Okay, so this is mainly the reason I like to go to the chart, so that you can see the variations of these candles. Okay, this is a bearish pin bar. That's an inside one of the candles we just read just now. The one which is like inside that V pattern candlestick. I even forgot the name, but the fact that you see it, you should know that it's something. Okay, bearish pin bar, variation. All these are bearish pin bars. Okay, so I hope you get the sense. Okay, I think for today that will be enough. Let's come back and resume tomorrow or the next time I read. So we'll resume from page 40. Then we'll start with the inside bar. Then we'll see how many pages we can do. So we've done 20. During the first one, we did 20, basically 19. The first one, 19 or 20 on the second one. So we'll resume from here. I hope this is sort of making sense for those who sort of struggle to read the books and understand and apply it on the charts. But basically, this is how you should do it. Then you should just practice. So I hope this was educational. Stay blessed.